Hello, welcome everybody. This is a keynote panel, Buyouts West. I'm joined with Marek Herchel. He is with AlpInvest, Managing Director and AlpInvest Fund Investments Team and Head of North America, with a focus as well on emerging markets in Latin America. As well, you're also a member of AlpInvest Investment Committee. You've been on board with the firm about a decade now, after joining from Fleet Fund Investors in Boston. Done a lot of work in Boston, I guess.
Yep.
And you're steeped in private equity. You've brought a slide presentation about how AlpInvest finds middle market GPs for its fund-of-fund investments. The middle market seems to be an area of enthusiasm, both for LPs and for the start of new firms looking to raise their first or second fund. So let's see how you guys do it. Let's walk through it.
Sure. Is this on? Good morning, and thanks for being here. So I have a few slides that we can go through, really focused on more how we select middle market GPs rather than how we source them. I think sourcing and securing access is clearly very important, but I wanted to focus here today on kind of what, give some examples of analysis we do and what are the things that we focus on. So just to set the stage, we think it's a very broad market in the U.S. in particular. There's over 1,000 sponsors who are active in what we define as the U.S. middle market. We track about 600 in our databases, of which about 100 come up and fundraise every year. We end up making, depending on which client's portfolio it is, anywhere between 2 and 10 or 12 commitments a year. And so it is a broad universe, and because the dispersion of returns is so wide, we really think that selecting the best managers is paramount to generating good returns. This shows the Thomson Venture Economics sort of quartile rankings across the years, and so you'll see that picking the managers in the top half versus the bottom half makes a lot of difference in terms of returns for the portfolio.
Quick question on this one, Marek. Why do you think it's so different every year? Is it because of the economic conditions, or just the lumpiness of private equity? Because those returns are kind of a little bit varied there.
Yeah, I think in the better years you'll get more managers that are in the upside as opposed to in the years that are a little bit more challenging, where a number of folks, the sort of weaknesses in strategy or portfolio construction become a little more apparent.
Right.
So this won't be news to anyone, but we look at our selection process, which is very iterative and kind of transparent with our investors, at the combination of strategy, team, and track record. And so is the strategy attractive over time? Is the track record in the strategy attractive? Is it attributable to the team? And is the team aligned with the LPs? And so I'll go through each of those relatively quickly here. First, the attractiveness of the strategy. So, this is one analysis we did earlier this year, looking at software or technology buyouts. There's a particular GP. You can see that relative to the publicly traded multiples, in some years they execute transactions at much higher multiples, some years at a little bit lower. What was important to us is that the numbers with the triangles next to them show the returns on those transactions. And so across the cycle, even when they pay meaningfully more than what the public companies trade at, they've still been able to generate good returns. And so from a strategy cross-cycle perspective, we think this one was quite interesting. We look at value creation. We deconstruct the portfolio, look at every single asset, how the equity value was generated in that asset, and then we sort of compile it all together for each sponsor. So here we have 2 sponsors. In the first case, revenue growth, margin growth, and a lot of multiple expansion. We typically don't regard multiple expansion as a very sustainable and replicable strategy. However, in this case, this sponsor focuses on a very niche segment of the market where they're the first institutional capital going into deals. And so multiple expansion, they've been able to achieve very consistently for a decade and a half. And so that was an interesting one to us. The second case, again, shows lots of revenue growth, lots of margin growth, and a lot of multiple contraction. So even though someone is paying a higher price, they're picking the right assets and are able to walk away with a number of profitable investments. Next is fit in the portfolio. This is software buyouts. Particularly this year, there's been a lot of activity on that front. a lot of fundraise at relatively large fund sizes. And so as we try to pick what we thought was the best GP out of that for our portfolio, we looked at what the exposure prospectively will be. So putting all the commitments together on a look-through basis, how much of the client's portfolio would be in software buyouts. And then we, of course, compared it to the S&P, et cetera, to make sure that we're not out of line. On assessing performance, there's a lot of benchmarks, the ILPA benchmarks, Venture Economics, Preqin. Mike's laughing because he's well familiar with that. And so we use those, but we also have some in-house resources that we've gathered over time. And so these are based on really tracking the GPs we invested with, but also all the prospective GPs. This is, the slide doesn't tell you much, but what we do is we look at performance on a vintage year basis, so vintage year for each deal, for each GP. And this kind of strips out the fund concept and really lets you look at, in a comparable peer set, what the asset selection of a particular sponsor is like. And so if in 2002, this particular highlighted one generated 3.2 on their deals, you can compare it to all the other deals done in the same vintage year by comparable GPs.
Can I ask one? Could you go back to that slide for just a second? Just a question. So you've got 2002 through 2009. Any kind of early indications on what any later, more recent funds, or are there any? If you look at what's going on right now, is there any year that it sort of compares to in that chart, or favorably, or anything?
I think in the more recent years, what we see is relatively fewer realizations. So I don't think it's a big enough sample set.
It's too early.
The ones from 2009 and 10 and 11 all look great because it was a great point in the cycle to put capital to work.
Yeah.
Oh, sure.
Very interesting point in there. You talked about, you showed an example of software buyouts. Mark really with Commerce Street Capital. You showed the software buyouts, and you said, well, we compare all these different areas to the S&P 500. But if you have something that's very sector specific, like we invest in commercial banks, do you still look at us compared to the whole S&P 500? So put us on based on an absolute basis, or if we really like, for example, we benchmark ourselves versus the various financial services, the Russell 2000 Financial Index, S&P 500 Bank Index. There's a specialized one called the SNL Small Cap Bank Index, et cetera. But we benchmark ourselves against financial services, so we're very sector specific. So can we don't think it's, hate to say it, we don't think it's fair that we get benchmarked against the S&P 500 because we're not the S&P 500. People invest with us because we're looking for a specific sector and specific expertise in specific sectors. So how do you think about that? We see somebody who's really sector specific.
Yeah, so this slide was to illustrate how we look at the exposure in the client's portfolio relative to where the market's at. So it's not to benchmark, we don't benchmark funds against S&P. What we do is when we pursue sector specialist funds, we benchmark them against all the other sector specialists. So we have very proactive sort of mapping exercises in each sector that we think is large enough to warrant them. And then we also would benchmark you against all the financial services investments made by generalist GPs. Because we believe if you're a sector specialist, you should be adding value relative to what the generalists are doing in the same sector. And so if those conclusions are positive, then we're more likely to consider someone for a commitment. This one is interesting. When we look at funds, I don't expect anyone to actually read this. It does exist. The last fund is usually held at cost or close to cost. Very hard to just look at the numbers and see how you benchmark that fund relative to peers. So what we do is use we have a large secondary team that's very active. We work with them to basically project an outcome for every single portfolio company in a GP's portfolio. And we roll that up into a fund level projection. And so let's say this fund is expected to generate 2.5 times. And we will have done that for every other GP that's comparable that we've assessed in the same vintage year. And so we have an internal way of benchmarking what the projected outcome on a fund is relative to the peer set. That's sort of a unique way we look at things. It's quite resource intensive, but
that's your crystal ball.
In ways.
Yeah.
If we were always right, that would be great.
Yeah. And
then last is the team dynamics. And so here, is the track record attributable? Are the right people getting the right share of economics? Does the compensation structure really align the GP and the LP? So we look at performance by partner and kind of what what the write-off ratios are, who's really delivered the most value. We look at fees per annum during and post-investment period. Overlay this with carry, dollars at work for the different partners, and make sure that the right folks are getting both the right share of economics, but also the economics are being driven by the carried interest rather than the fees. Then lastly, this is a kind of a turnover mapping exercise, looking at the history of each person at the firm, what level they were at in what years. We overlay that with the deals executed in those years to make sure that the team we're backing going forward is the team that's been successful in the past. This is a slide that will be familiar, really based on the ALPA principles. We look for GPs that have good alignment of interest, governance, and transparency, and try to negotiate in a reasonable way to get to a sort of common ground. I think this is the last slide. This is an example really of a GP that we proactively sourced, approached, built a relationship with over the years, did full due diligence not too long ago, but decided to walk away at the end. Really couple things. One was the ambitions of growing the franchise we think were outsized relative to what we're comfortable with. But even more importantly, we sensed a lack of partnership spirit in the negotiations, and so the sponsor behaved in a way where we really took pause and thought about it twice whether we wanted to start a long-term relationship for the next 10 plus years. So that's all the slides I have.
Okay. I had a couple other questions for Marek as well, but before I continue with those, does anybody else have a question about the slide presentation so far? Okay. Having said that, I just wanted a couple things from the slideshow that I noticed. You mentioned software as a niche. Are there any other niches that are sort of gaining traction right now that you're seeing out there? Because we hear a lot about niche funds. Like I was just talking to a guy earlier. He says that there's not that many new LPs out there, and they all have private equity investments. So now the idea is trying to find the right niche. So anything that's jumping out at you in the niche category?
Yeah, over time, we've been very active in various industry-specific funds, I guess. We spend a lot of time on healthcare.
Yeah.
We're spending a lot of time on consumer. We've seen very nice returns in both of those.
Well, that's interesting to hear about consumer, because you always think of the GDP growth in the U.S. is relatively tame, but I guess if you get the right consumer company,
right,
it can grow very quickly. Yeah, it's attractive.
Yeah, no, and we've seen success on both ends of the spectrum. One is at the very sort of high-end, consumer-targeted items, and then as well, and services, and then as well at the very low-end, things like Dollar General and others.
And the other thing that jumped out at me was that you look at each manager at each individual private equity firm, and kind of like each batter on a roster, on a baseball team or something, or a football team. I want to ask about track record, because a lot of these guys or men or women will start their own spin-off firm, and sometimes they may not be able to negotiate their track record. Are you able to kind of cut through that and see which deals they actually worked on, even though they may not be able to legally negotiate a specific track record item?
Yeah, I think this is where the network that a firm like ours and others have in the market is really crucial. So being able to kind of talk to the off-list references, to the CEOs, to the managers involved, to the bankers, to the to the attorneys, to other people in the industry, and really create a picture of which deals are attributable and which ones are not. Because even when there is official attribution provided, oftentimes it's not sort of 100% reliable from our perspective.
It could be a little, it can be a little dicey at times. So let me ask you about the separate accounts business. One of the challenges the fund of funds have had are fees. It's the same challenge you see in the public equities market as well. There's a lot of sensitivity around paying mutual fund fees. So what's happening, we did a cover story about this in Buyouts, about the separate accounts business. Some frequent numbers on that. It's an estimated $75 billion under management by the top 10 private equity advisors in the business. So what's the appeal from your perspective of separate accounts? And could you bring us up to date on what AlpInvest is doing there? And how does it save on fees?
Yeah, so I think the fund of funds business is a maturing business, and as such, economics usually come under pressure. Sure. I think the sort of one-size-fits-all approach doesn't work any longer. The other trends we see is LPs are really consolidating the number of relationships that they're trying to manage. And so if you can provide a customized, flexible solution within one manager that addresses their needs over time across segments and geographies, it's much more attractive. There are also LPs that are insourcing some of the capabilities that they used to use fund of funds for.
They have to insource for doing like co-investments and that kind of thing. So they
right, or they're building their own teams just to pursue, let's say, the high end of the market where they don't really want to use a third-party provider. We've been really in the separate accounts business since our founding. So we were started as really a captive private equity investor for two large pension funds, and so we would sit down with them and plan the kind of objectives and execution for their mandates, revisit that every 6 to 12 months, see how we're tracking, what shifts they wanted to make in allocation. And so from that perspective, we think we're very well positioned to continue to execute on that. We have clients who, a year into a 3-year program decide that they want less venture, they want more buyout, or they want more emerging markets, more co-investment or secondaries, and we're able to accommodate that. So it's a much more flexible structure that we see both small and large LPs pursue. The small ones where they think about outsourcing most or all of their private equity activities, and the very large ones where they're looking to fill specific holes in their portfolio with a separately managed account.
So are you any kind of ballpark figure with how quickly your AUMs are growing for your separate account business? Is it like 5% a year at this point, or double digits or anywhere like that?
I'll say the bulk of the growth for us has been in the separately managed accounts.
Oh, separately managed accounts, and that's growing by how roughly at a good clip still, or?
Yes.
Okay, good clip is a good way of knowing. And are you where you want to be in terms of staffing for your separate accounts business? Are you hiring anybody there?
Yeah, so we started a group when we diversified from 2 clients to a larger number that we call investment solutions, and these are really the folks who are on the front lines with the clients. So if you have a separate account with us, you're facing one kind of customer service person, regardless of what your allocation within the account is. And so we've really staffed up that group over the last couple of years.
Okay, but is it kind of where you want to be? Are you hiring anybody now?
We're still adding in that business.
Still adding?
Yeah.
A few people maybe? Or?
Yeah.
Okay. So Carlyle Group acquired a 60% stake in AlpInvest in 2011 and then bought the remaining 40% of the firm last year. AlpInvest has more than $47 billion under management, and you're operating under the Carlyle Solutions platform, which is fund of funds, real estate investments, and other types of investments. Just bring us up to date on the Carlyle relationship. Do you ever get word of funds through them, or do you ever tell them about a fund? Is there any kind of exchange of information going on?
Yeah, no, that's a good question. So Carlyle first acquired about 60% 3 years ago. Now they're full owners of the business. The idea is to really build what we're calling a solutions business. And so we acquired Metropolitan Real Estate, which was a real estate fund of funds provider, and Diversified Global Asset Management, which is the same on the hedge fund side. And so now we have private equity, hedge funds, and real estate under the same umbrella. And so really the goal is to be able to come to a client, and instead of providing a specific product, if you're a hammer, everything looks like a nail, to construct something that goes across the asset classes. And so we've been doing that for the past, we made these acquisitions in the past 12 months. Mm-hmm. And so we're in the early stages of rolling those products out. Say it's someone's concerned about inflation, we construct something across these asset classes, and we could add something from Carlyle's realm of commodity trading, et cetera, to kind of add to that and build something very very unique for them. We recently had one of our clients shift some exposure from the private equity sub-asset class to real estate, and they could do that with us without adding a new relationship to their roster, having the same client interface, and so it seems to work very well.
So I did a story too about Carlyle and how their middle market private equity buyout fund, Carlyle Opportunities. Sometimes they work with deals on the flagship fund, so they work together. There's a little bit of cross-pollination going on. Does that cross-pollination include anything that you guys are doing?
Yeah, so with us it really goes one way, because we have relationships with sponsors who directly compete with Carlyle.
Right.
we co-invest with sponsors in transactions where Carlyle may be bidding on the other side. And so there's a solid information barrier where it really would put our business in jeopardy if we were to share information with them on anything like that. And so there's a very clear sort of separation of church and state, if you will. What we do get to leverage, bless you, is getting industry insights from the Carlyle folks. And so they have big efforts in infrastructure, energy, private equity around the world. And so leveraging that and sort of building out our knowledge set further has been very helpful.
Okay, so I'm going to ask you about AlpInvest's secondary programs. It's more than $4.2 billion. What's the reason behind the stronger interest in secondaries, and could you bring us up to date on AlpInvest Secondaries Fund 5, which closed at its hard cap of $750 million last year? When would you expect to launch Fund 6?
So for compliance reasons, I can't answer the last part of that question.
Okay, I can still ask it, but you can't answer it. That's fine.
But over the years, and we've been active in secondaries for a dozen years, and the practice works very nicely with our primary program and our co-investments in terms of leveraging the information flow and the relationships. What we've seen more recently in the secondary market is very intense competition. And I was just chatting in the hallway with a couple folks who have the same view, which is the straight LP interests that are being traded at very high prices. And there's a number of players using meaningful amounts of leverage to get those, to be very competitive in those transactions. From our perspective, that really pushes out the cash flow from the secondary transaction, which eliminates the benefit that we're looking for, which is to combine that with a primary program and really get a return of capital much faster for our investors. So what we've been focusing on in the secondary market is really more complex transactions, and this is where our co-investment and primary expertise really comes to bear. We can bring it to bear, doing spin-outs, doing sort of midlife fund restructurings. We just announced the One Equity transaction, which was a spin-out from JP Morgan, a very substantial deal that we worked on for a long period of time, and we think is a very unique asset for our investors to have.
So your secondary business sort of spun out and it resulted in the kind of a birth of another private equity firm. That's pretty interesting.
Yeah, we've done that a dozen times probably in the past, particularly out of banks where, due to regulatory changes, they have to get rid of some assets. We find those transactions to be very interesting because we can align ourselves with the management team very nicely. They know the assets really well, and it tends to be a information advantage process for us relative to just a competitive auction for an LP portfolio.
And given your work, looking at different funds, especially in the middle market, we're definitely seeing a lot of talk around Europe, investing in Europe. Are there any exciting things going on there with AlpInvest?
Yeah, so our heritage is European originally, and so Europe's been a very active part of our portfolio. We are very active in the middle market in Europe. I think over time we've picked our spots in terms of geographies. We recently made commitments to a couple of smaller Spanish mid-market funds.
Oh, that's interesting.
We think it's the right time to be putting some capital there, for example.
Okay. And, one of the things that fund-to-funds advantages you have, you're sort of an LP and you're sort of a GP at the same time. Give us a window into what the LPs are doing right now. What are they thinking about? Are they thinking about increasing their allocations to private equity? Are there any types of funds they're really interested in right now? Any kind of insight there?
Yeah, I think probably will be said a few times today. We've seen a lot of distributions. The past 24 months. It's been kind of a 2 or 2.5 to 1 relative to capital contributions, and so people are getting a lot of money back. Public equity valuations are up, and so there's kind of a reverse denominator effect where PE becomes a smaller part of the portfolio than it's been targeted at. So we see a lot of LP appetite for new commitments. The fundraising market's been very active. There seems to be a lot of interest in energy, infrastructure, kind of real assets on top of the traditional buyouts as well.
Yeah, that's as a hedge against inflation, I guess.
Right.
You get inflationary tied investments. All right, well, I guess we're just about out of time. We might have time for one question if anybody has any other questions. Okay, that's about it for us for the moment. Thanks for joining us, and we'll have a round of applause for Marek.
Thank you.
Thanks.